Equity Trust is probably one of the leading companies in self-directed IRAs. And people don't understand what a self-directed IRA is. I know when I first started my IRA, my stockbroker said, you want this stock, this mutual fund, or this mutual fund. That was my choices. This is truly self-directed. And we happen to, Ohio happens to be home to the leading company in self-directed IRAs. So it is with great pleasure that I introduce John Bowens from Equity Trust.
Thank you very much. It's certainly an honor and a privilege to be here. We've been routinely attending the GDREIA meetings, I want to say, for north of a decade, if not close to 2 decades. Before my time, it was my mentor and the founder of Equity Trust Company, Dick Desich. Is anyone familiar with Dick Desich or seen him speak? Yeah, he's really the pioneer of the self-directed IRA industry. And I came to the firm about just over 7 years ago now, in fact. And Mr. Desich sort of took me under his wing and mentored me throughout the process. And just about everything I know, I learned from Mr. Desich, his 2 sons, Rich and Jeff. Some of you might be familiar with those gentlemen as well. And many other practitioners in the industry that I'll talk about throughout the presentation. To introduce myself, my name is John Bowens. I'm the Director of Education with Equity Trust Company and the Retail Business Development Manager. In those roles, I go out throughout the country and I teach and educate and inspire individuals to use a self-directed IRA, 401k, or other tax-exempt account to buy and sell real estate. So the purpose of today's conversation and presentation is to help you understand how you can use an IRA or 401k that you have elsewhere and begin self-directing it, not just in stocks and mutual funds like Marcia had mentioned, but into real estate notes, tax liens, private equity, and various other alternative investments. If you're someone who doesn't have an IRA, maybe you never set up an IRA, you had an IRA many years ago and you liquidated the account to do some real estate deals, not knowing you could self-direct it, we'll talk about how you can utilize a new IRA to start doing deals and significantly mitigate your tax liability. Equity Trust Company, Marcia was very kind in her comments. We are considered the leader in self-directed IRAs as it pertains to investing in truly retail alternative assets, particularly real estate-based assets. We have over 130,000 customers nationwide, and we custody just over $12 billion in assets. We are a very small fish in a very large pond in terms of the retirement financial services industry, right? The Fidelities, the Schwabs, the Wells Fargos, the Pershings of the world, they have trillions of dollars, right, in assets under custody, whereas we only have just over $12 billion in assets under custody. But as far as self-directing into real estate, we're the largest. In fact, there's only about 500 to 600,000 per the SEC, Securities and Exchange Commission, individuals in this nation that are actually buying and selling real estate and other truly retail alternative assets with their IRAs, 401ks, and various other retirement accounts. So it has been my goal to educate the public and let people know and scream at the top of a mountain, as loud as I can, that you can buy and sell real estate with IRAs and 401ks. Because there's a lot of naysayers out there, right? Some of those individuals are financial professionals because they have a vested interest to not allow their customers to migrate their wealth away from stocks, bonds, and mutual funds and into real estate. So there's unfortunately less than 2% of individuals that are actually doing this, actively investing in alternatives with their IRAs. So my goal today is to make a change to help you understand how you can use your IRAs and 401ks and various other retirement accounts to buy and sell real estate. But I also want you to be advocates of this concept. I want you to be ambassadors, if you will, of this self-directed IRA concept and go out and work with potential lenders, private lenders, investor partners, educate them on how they can use their IRAs and 401ks. There's over $24 trillion in IRAs, 401ks, and various other retirement accounts. For those that are working with military employees, for example, they most likely have what they call a thrift savings plan, TSP plan, which is essentially the equivalent of a 401k for federal government employees, which are typically very healthily funded because the government almost has a guaranteed match on an annual basis. Whereas many large corporations, when they're struggling, they back off on those matches. So getting a little bit far into the weeds there, but the point that I'm making here is that you can actively pursue private lenders and other investors, and potentially by educating them on the concepts that we're talking about, be able to capture their funding to do your real estate deals. Again, there's over $24 trillion in IRAs, 401ks, and various other retirement accounts. And there is a demand for alternative investing. Investors like this gentleman here mentioned losing a significant amount of money in the stock market. There's a number of individuals in 2007 to 2008 and 2009 had 50 to 60% of their portfolio cannibalized by the diminishing returns of the stock market. Some of those individuals, although they have since recouped their losses, are looking for alternative investment opportunities. They're looking to migrate away from Wall Street and onto Main Street. And you can be an individual that can help them achieve that in creating an alliance, if you will, with Equity Trust, so we can educate those customers, onboard their self-directed IRAs, and then you can begin issuing notes and mortgages or deeds of trust. You can start doing deals with those individuals. Okay, so this conversation and presentation, really it's taking two perspectives. One, how to grow wealth for you and your family and many generations to come using IRAs, 401ks, and various other retirement accounts. And then also, again, how you can begin incorporating self-directed IRA concepts as another pillar in your business to go out and find private lenders, private money, investors, etc., etc. There are two primary purposes of why we find real estate investors come to Equity Trust Company and seek out our education and our services. The first is someone who has an IRA or 401k, maybe it's a Roth, maybe it's a traditional, we'll talk about those accounts. They have an old TSP plan, maybe they work for the county, they have a 457. You might be familiar with those types of plans, or a 403B, teachers for example. These are all essentially different numbers that equate to a retirement account, okay? And those are individuals that are most likely fully vested in maybe 6 to 7 to 8 different mutual funds. And they're relying on modern portfolio theory and the assumption that the various correlations to the stock market create the optimal portfolio which will be able to last them many, many years. Unfortunately, when there's a significant hiccup in the market, that doesn't always stand true. These are individuals that want to migrate, maybe not 100% away from stocks and mutual funds, but want to migrate maybe 40, 50, 60% of their retirement account to hard, tangible assets that are not correlated to the traditional stock market, that can significantly modify the volatility of their portfolio and increase yields over long periods of time. So again, individuals that have IRAs and 401ks that want to leverage their knowledge and expertise in the real estate space begin putting those IRA monies to use in real estate, whether it's buying single-family homes, multi-family homes, buying, fixing, selling, buying, fixing, holding, buying on owner financing, selling on owner financing, buying, selling on a rent-to-own, whatever it may be, lending money secured by real estate. Okay, they're looking to leverage their knowledge and expertise investing in assets that aren't correlated to the market. The second individual that we see that seeks out our guidance and our services is the real estate investor that is looking for ways to significantly mitigate their tax liability. See, one of the things you're going to learn, and if you read the Internal Revenue Code, Section 408 or 408, if you're interested in any light reading, anyone who's seen me speak before, you'll know I don't have many jokes. That's one of my zingers that I have, is the Internal Revenue Code and the light reading. I enjoy reading it, to be honest with you. I spent 3 hours with my investments team earlier this morning actually dissecting the Internal Revenue Code. We'll talk a little bit more about that, things you can and cannot do with your IRA. This is something I'm extremely passionate about. But the point, going back to that I was trying to make here, is that your IRA, your 401k, Section 401 for 401ks, by the way, 408 for IRAs, it states in black and white that your IRA is tax exempt. Okay? Now what does that mean, tax exempt? What that means is through your investment activities, when you buy, fix, and sell, and you have long-term gains, when you buy and hold and you have rental income, when you lend money, you accrue interest, and that interest goes to your IRA plan. So it's not you doing the deal, it's your IRA. Your IRA buys the asset, your IRA receives all the income. All of that income is either tax-deferred or tax-free income, depending on whether you have a traditional or Roth. Now we'll talk more about that. But what's important to understand is that income does not show up as income to you when you're doing a deal. It doesn't hit your Schedule C. It doesn't hit your 1040. It's in your IRA. And the government set up these IRAs going back to 1974 for this primary purpose, to encourage individuals to save for their retirement. And the advantage of putting money into a retirement account and saving for your retirement, so you don't have to rely on the government, Social Security, and your friends and family, is growing wealth tax-free and tax-deferred. In the early 80s, real estate investors developed the idea, in fact it was our company founder, Dick Desich, developed the idea of saying, hey, why not go out and start doing real estate deals, make significantly higher rates of return than I can get in the stock market, and it's all tax-free and tax-deferred. So going back to that individual that's looking to mitigate their tax liability, if you are a real estate investor and you're looking for ways to mitigate your tax liability, whether it's today, next week, 2 years from now, 6 years from now, whatever it may be, IRAs in the tax-exempt accounts that we discussed today can allow you to do that. Let me give you a quick example. Do we have any individuals here that wholesale properties? Do we have any wholesalers here? Okay, so Robert, last wholesale deal you did, what was your assignment fee? $10,000. So let's say, as a for instance, I'm going to use my Roth IRA. Let's use Robert for example. Robert sets up a Roth IRA with Equity Trust Company, puts $500 in the Roth IRA. That's after-tax money, okay? He puts a deal under contract in the name of his IRA. So Equity Trust Company, custodian, FBO, Robert's IRA, and/or assigns to. We'll talk more about this, okay? And/or assigns to. He puts down $100, let's say, as his consideration money for this deal. So his IRA invests $100, just like the IRA would invest in a stock or a mutual fund. Robert then, let's say, as a for instance, in less than 30 days, assigns that contract to another investor, okay? Assigns it to another investor, he gets $10,000 as his assignment fee. That $10,000 goes to his Roth IRA. So that $10,000 doesn't end up where? On his Schedule C. It doesn't end up on his 1040 as ordinary income. That's going to be active ordinary income, right? Correct me if I'm wrong. If Robert's in a high tax bracket, he's going to pay a significant amount of taxes on that money, right? It's in his Roth IRA. So the phrase that I always use to help people wrap their head around this, and if you're working with private investors, this is a good phrase to use. We're talking about how you can significantly divert income that would otherwise hit your 1040, your Schedule C or Schedule E and your 1040 and in your IRA plan, okay? Now, this doesn't mean you're going to be able to do every single deal inside of your self-directed IRA, right? If you're somebody that's growing a real estate business, you need retained earnings, right? You need capital for your business to reinvest in other projects. Maybe you want to use some of that money for a retirement, and you're well under the retirement age of 59 and a half, so you can't take money out of the account. So I'm not suggesting that you're going to do every single deal inside of an IRA. Maybe you do 2 deals a year. Maybe you do 3 deals a year. Maybe you do get to a point in your life and your lifestyle that you do every deal inside of an IRA plan. Everyone is different. So I'm not going to suggest or show you a system or a program, if you will, that is one glove fits all. Okay? Everybody's situation is different. But we work with each individual client in an individualized basis to determine what their needs are, what their wants are, what account types they need, where their funds are at now, how to get them over to a self-directed IRA, and then they can start to strategize and plan as far as how many deals they want to do per year, how many deals they can do, et cetera, et cetera. Okay? So I just wanted to add that sort of disclaimer up front, knowing that if you are an individual that doesn't have an IRA, don't feel excluded from this conversation, because we'll talk about ways in which you can significantly organically grow a retirement account where you can then move on to a buy, fix, and sell or buy, fix, and hold strategy. And there's a lot of investors in here today through networking that can also help show you how to do this. There are investors here today, I know of them personally, that have done these deals inside of Roth IRAs with small amounts of money, and they've been able to grow wealth significantly. For some people, it's 1 IRA. For some people, it's 15 IRAs in investment accounts for themselves and their entire family. Marcia, I know you visited us up in Cleveland during our IRA summit. There's a gentleman there by the name of Stan Brady. You probably remember his conversation on doing real estate options in his IRA. He has 15 IRAs and investment accounts for himself, his in-laws, his children. We'll talk about setting up IRAs for your children, and other family members. So he has this entire constellation of IRAs that are all tax-free. Okay? So that's sort of real high-level, macro, what we're doing, what we're talking about today. Okay? As you can tell, I'm very passionate about this business. I do have a tendency, and I'll apologize in advance, to meander in many different areas of this business. My goal here is not for you to retain 100% of what I talk about, right? My goal is here to, yes, talk at New York speed, for you to retain maybe 40 to 45% of what I talk about tonight, and then I will give you the resources and the information to expand on this conversation. You take nuggets of what I say based on your individual situation, and then we can talk individually, you can talk with one of my staff members, to actually understand more about what you can do with these programs, our services, and the self-directed IRA in of itself as a vehicle for you to be able to invest in real estate notes and other alternative assets. I speak as passionately as I do about this business because I do self-directed IRA investing myself. I have a self-directed traditional account, tax-deferred, and Roth, and it's 401k. Okay, so you can self-direct a 401k if you're working with the right company or you've set up the right plan for your business. We'll talk more about that. But for a lot of people, it's IRAs. 401ks and IRAs, they're almost synonymous, okay? So when I talk personally about what I do, I'm going to say 401k because I use my self-directed 401k primarily to do deals. Now, I primarily make loans secured by real estate. I'll talk maybe a little bit about what I do, but I try to keep this more oriented towards what our customers are doing and showing you case studies of what our customers are doing, okay? But I want you to know, as we go through this process, that you're working with an institution, you're working with an individual that's out self-directing their retirement account. Now, I should add in the disclaimer, when I say that I make loans with my 401k, I would prefer when people approach me after the session to ask me questions about how to grow wealth for themselves or their other investors, and not ask if I have available capital right now to lend them on their projects here in Dayton. You know, I chuckle because almost every presentation I deliver, I always have at least one person that afterwards says, hey, do you by any chance, have any interest in investing in this area? I got this really great deal. I'm like, no, there's a conflict of interest. Even if I wanted to, I probably can't. So, please network with somebody else, but I'm not the guy, unfortunately, to help you with that. I am natively born in Cleveland, Ohio. My home base is up in Cleveland. Our office is in Westlake, Ohio, by the way. If you want to come visit us, feel free to do so. We're right off of the Crocker-Bassett exit, if anyone is familiar with the Westlake area. But I grew up in the greater Cleveland area. I still live there to this day. I invest in Cleveland. I also invest in Tampa, Florida, using my self-directed 401k. So just a little bit about me. I don't spend too much time talking about myself, so let's go ahead and just move into the content portion of the presentation. Before I begin delivering a lot of the content, it's important that I add this disclaimer. Everybody needs to understand what we do and what we don't do as an institution, and what I do and don't do as a self-directed IRA practitioner. So, Equity Trust Company. We are a passive self-directed IRA custodian. We are a bank-regulated institution. We hold a trust charter from South Dakota. It's chartered out of South Dakota specifically because they have favorable trust laws. Your IRAs exist in perpetuity. That's very, very important. That means when you pass away, it's left to your children or grandchildren, tax-free to them, most importantly. Okay, it avoids probate. We, as a bank-regulated institution, need to make sure that we let everybody know here today that this is for educational purposes only. I nor Equity Trust, ongoing, will render tax, legal, or financial advice. We provide guidance as your passive custodian. We'll set up your IRA for you, allow you to transfer your funds over, and then you make the decision as far as where you want to invest those funds. I'm not going to tell you or compel you to do anything with your IRA. You ultimately have to make that decision. Equity Trust Company doesn't perform due diligence on your behalf. So if you want to lend money to an investor, okay, you need to make sure that you check out that borrower, right? Do some character references, background check, whatever it may be. Look into their company that you're lending money to, right? You're not going to lend to individuals, you're going to lend to an LLC likely, right? Lend to a company, corporation, or LLC. Maybe you want to go on to the Edgar report, maybe you want to go onto the state secretary's website, check out your borrowers, right? Equity Trust is going to do that for you as your custodian. You also want to make sure that if needed, you consult with your tax professional or CPA. We can get you about 98% of the way there typically, But in some instances, there are questions that are better suited for a financial advisor, not so much usually a financial advisor, but a CPA or tax attorney, okay? We provide a lot of guidance, though, in education. Again, getting you 98% of the way there. Most of our clients that we work with, they do deals with their IRA plan. They're cut and dry deals, and usually doesn't require the need for them and the cost they would incur to consult with a tax professional, legal advisor, etc. Okay? I apologize for the long-winded disclaimer, but it is very, very important, again, that we let you know what we do and do not do. So going forward, we can have a healthy relationship. Okay? So, we're going to go through the 7 tax-exempt investment accounts. Okay? Traditional IRA, Roth IRA, there are 3 small business plans, the SEP IRA, Simple IRA, and Solo 401k. And then last but not least, there's a Coverdell Education Savings Account, which is a really neat plan for the children and grandchildren. And then also a health savings account. All tax-exempt accounts, all fall under the auspices of this self-directed concept. All can be used to buy and sell real estate and loans, etc., etc. Now, the important thing to understand, going back to our initial conversation about tax-exempt status, is understanding compounding interest and the very basic fundamentals of compounding interest. This calculation here, what calculation is it? It's the compounding interest. It's the future value calculation. And you see a number of variables here. We're not going to go through all the specifics of the mathematics. You can do this on an Excel spreadsheet, or if you have a, I think it's BI2 of some sort calculator, you can perform these functions. What variable have we not included in this future value calculation?
Current value.
Not necessarily. Taxation. So I have not included the variable of taxation. That can get quite complicated because people's tax rates differ, right? So we really have to build out a more advanced Excel spreadsheet model. This illustrates the crippling effects of taxation on your long-term gains, okay? What I'm doing here is I'm showing you the advantages of using an IRA. Now, you do every deal with an IRA again, but showing you the intrinsic value of using an IRA, 401k, or other tax-exempt account. It's a little bit difficult to read, so let me talk through this with you. If I start with $50,000 today, I grow it over the next 20 years, earning a modest 10% per year, compounding just once per year, I will have saved in an IRA, remember tax exempt, saved in an IRA just over $336,000. Now I take that same $50,000 seed money, okay, I grow it over the next 20 years, earning a modest 10% per year, compounding just once per year. I will have saved in a taxable environment, factoring in a marginal tax rate of 25% and a state tax rate of 6%, just under $200,000 saved. Okay, so that's over $141,000 in taxes paid over that 20-year period. Again, factoring in a 25% marginal tax rate and 6% state tax rate. Okay, so that's as you can see, the crippling effects of taxation. I've built more advanced models with Excel spreadsheets actually doing a comparison. If I buy a rent property and I rent it out for 10 years and I reinvest the accumulated capital into treasury securities, and then once I get enough money, invest in a second rent home, and you'll find over 20 to 25 years with long-term gains on the sale of the property and the recaptured depreciation that the IRA always wins. You're always going to pay less in taxes in an IRA. There might be some instances, okay, and there might be some individuals that have varying circumstances where it might not be advantageous for them to actually do deals in their IRA, okay? But what I find in all the analysis that I've done, in well over 90% of the cases for individual Americans, IRAs will win, okay, because they have that tax advantage component that's inherent. It's like a 1031 exchange, but there's no limitations. That's sometimes the analogy that I use. So the IRA, you just do deals, it's a revolving door, and the money goes in tax-free. You take it out tax-free to do a deal, it goes back in tax-free. You do another deal, it goes back in tax-free, so on and so forth. There's this concept of tax-free dollars, right? And those tax-free dollars create more tax-free dollars, which create more tax-free dollars. I don't know if there's anybody in law enforcement or have done any legal work, but there's the fruits of the poisonous seed doctrine. Some of you might be familiar with that, right? So that one seed can create a significant amount of more seeds, more trees, etc., And the concept here is that you can create more tax-free dollars, which accumulate more tax-free dollars, et cetera, et cetera. I'm going to go through real estate transactions with your IRA plan, how to do it, okay, the different types of real estate investments that we see, and I'll go through some case studies, et cetera, et cetera. There are 3 ways in which your IRA can do deals, or any other account that we talk about can do deals. The first option, your IRA buys the property 100% outright. Your IRA pays for all fix-up and repairs. Your IRA receives all of the profits from the rental or sale. The second is where your IRA may co-invest with a spouse's IRA. I'll show you a case study of this. May co-invest with a child's covered education savings account. Maybe you have 4 or 5 or 6 IRAs in on one deal. Or your IRA may co-invest, and I'm using the term co-invest for a very particular reason. We do not want to use partnership. Okay, we'll talk more about that. Co-invest. You can co-invest your IRA with your LLC. Let me give you an example. Let's say, as a for instance, you're going to buy a $50,000 rent property. You're going to take $25,000 from your IRA, and you're going to take $25,000 from your LLC. You're going to go into a tenants in common arrangement. So you're going to co-invest the IRA with the business. So on title, it will list Equity Trust Company Custodian for the benefit of your name or account number, IRA, undivided interest 50%, because that's the proportionate amount of capital outlay put up, and then 50% your LLC. So on title, you have your IRA and your LLC. Going forward, all expenses are paid 50-50, so everything has to flow concurrently. And then when you rent out the property, 50% of the rents go to your IRA, 50% go to your business. When you eventually sell, 50% of the profits go to your IRA, tax exempt, right? The other 50% go back to your LLC, which are subject to taxation. It might not be 50-50. Maybe you only have enough money in your IRA to get 10% equity in the deal. Okay? Now, I mentioned flowing concurrently, right? And I'm pro rata, in other words. That's very, very important. We'll talk more about it. But what I want everybody to know now is when you co-invest, you are co-investing with what they would consider a disqualified person. If it's you, your children, your parents, any businesses that you're associated with. So you have to proceed with caution. That's why everything has to flow concurrently. I say this now because there might be some people that have been to some IRA trading before that are saying, wait a second, he's telling me something that's illegal. You can't do that. You can in fact do it. You just have to do it properly. And we'll show you how to do that. Okay? Last but not least, as far as financing options, your IRA can take on debt in the form of a non-recourse loan. All right? What is a non-recourse loan? There's a special provision within the document that actually states in the event of a default, the only recourse is against the subject property. Conventional financing, what does it call for? What do you do as an individual when you sign a loan agreement? Personal guarantee. 4975C1B of the code, if you're interested in any light reading, considers that an extension of credit prohibited transaction. So if you go out and get a conventional mortgage, the lender likely wouldn't even do it for you. But if you did, you'd actually be doing something that's in violation of the tax code, and your IRA would implode. It would cease to exist January 1 in the year in which you got that loan. So you have to use a non-recourse lending institution. We have a list of them. If you're interested, I can send that to you. Or you can use private lenders, individuals that you meet in rooms like here. In many cases, individuals, private lenders, are willing to write non-recourse paper. Because are they actually going to try to go after the individual anyways? Probably not, right? Through deficiency judgment, probably not. Maybe, but most likely not. So they're usually willing to lend on a non-recourse basis. More of an advanced strategy. Don't have the time this evening to get into all the weeds on that. Know that you can do it. It's more advanced, and we have more information available for you. I don't want to deter you, though, from leveraging, because it can be an extremely, extremely powerful strategy with your IRAs to be able to grow wealth organically. As a for instance, I know a guy who set up a Roth IRA with $5,000. And it was the first IRA that he'd ever set up. He was a little bit older. He was looking to catch up, if you will, because he had never had a retirement account before. And he wanted tax-free money. So he set up this Roth, put $5,000 into it. He bought nearly 50 rentals using private funding from other investors, some of which were using IRAs. His Roth IRA only had $5,000 in the deal. Financed the remaining amount for the acquisitions and the rehab of these rental properties. And he did have to pay a special tax called unrelated debt financed income tax. Has anyone heard of that? When your IRA takes on debt, your IRA unfortunately does have to pay this tax. Okay, that's one of the caveats to all of this. Is it bad? No. In this case, he paid some taxes in the first 3 to 4 years, but eventually, once he paid off the loans, he had nearly 50 free and clear rentals in his Roth IRA, well over $2 million of assets in cash, all of which is 100% tax-free to him, his children or grandchildren, whoever he leaves it to. He takes a distribution of the properties, he doesn't pay tax, he gets distributions of cash, he doesn't pay tax, etc., etc. So a lot of really interesting strategies that can be used in this space. We'll go through the transaction process and assembling your self-directed IRA team. So you're going to want to know who the attorneys are that work in this space. Many of them have probably come here to GDREIA. You're going to want to be able to network with other clients here at Equity Trust. We have a virtual system as a client of ours called My Equity that you can go online. If we have time, I'll show you what that looks like and the functionality. But you can network with our other 130,000 customers nationwide, 24 hours a day, 7 days a week, 365 days a year. It's called the My Equity Trust Online Learning Community. So great tool to be able to utilize. The prerequisite is you're a client of Equity Trust Company, but it's a great resource to start to build your self-directed IRA investor team, if you will. One of the gifts that I have, and I'll pass around my postcard here that I have for everybody. If you don't mind just passing those back, I'll drop a few here. One of the gifts that I have for everybody here, I'd ask you to fill out this postcard to your best ability throughout the remainder of the presentation. We put together, myself and our company founder Dick Desich, we co-authored this book called The Self-Directed IRA Building Retirement Wealth Through Alternative Investing. We have it in electronic form. Fill out that card. Okay, we're going to email this book out to you in the next couple days. Okay, I'll get back to the office tomorrow. You'll probably get it Friday, no later than Monday. This is an e-book, okay, comprehensive overview of self-directed IRAs. A lot of what we talk about today we'll expand on. There's even links, digital links in this book to different webinars and different white papers and information, okay? Also, we'll make sure to add you to our webinar list. We do webinars about two a month with different industry experts, anything from notes to we have attorneys that come on with us. John Heyer, Marsh, I know you're familiar with him. He'll be on in another month or so, talking about the more legal aspects of this business. So a lot of great information. That postcard also serves as a way for us to communicate with you going forward if you choose to do that. So if you would like a phone call after this presentation and schedule a consultation with one of my account representatives, please write down there, please call. Okay? That way we can reach out to you, schedule a consultation, talk about what makes sense for your situation, answer any questions you have from today. If you don't want a phone call, please write down there, please don't call. Okay? But at least take advantage of the ebook. If you have any questions, feel free to write those on there as well, because those are helpful for us. As far as the ebook is concerned, again, you're going to get an email, and you'll be able to download this in PDF form, and then you just point and click and go to the other resources. If you're a client of ours already, where are my clients, by the way, of Equity Trust Company? I know we have quite a few. Thank you very much, by the way, for your business. Very much appreciated. Feel free to fill that out. Even though you're a client of ours, that doesn't mean you're excluded from getting the ebook, okay? It's absolutely free of charge. There's no upsell or anything of that nature. So I'll let you take your time and fill those out throughout the rest of the presentation. So these 7 accounts, what are they? I'm not going to have time to go into detail of each particular one, but I'll give you the resources so you can take a look at those on your own. The traditional IRA and Roth IRA is what we'll talk about and go a little bit more in depth on. There are 3 small business plans. So as a small business entrepreneur, you may consider getting more money into an IRA per year by setting up a small business plan. To put it into perspective for you, with the SEP IRA and solo 401k, you could potentially get upwards of $50,000 into a plan, okay, in a tax-advantaged environment per year, compared to a traditional or Roth where you can only contribute up to $5,500 or $6,500, depending on your age. Okay, so that's the key takeaway with these small business plans. And then there's 2 alternative accounts, the covered education savings account and the health savings account. Before I go a little bit more in depth on the traditional and Roth IRA plan, what can you invest in with your IRA? When we say alternative investing, what am I speaking of? I'm talking about assets, again, that aren't related to the stock market. What are our clients doing? They're buying, fixing, selling. They're buying, fixing, holding real estate. They're investing in apartment complexes, multifamily. Typically, when we see multifamily, there is an investment sponsor or syndicator that's raising money, right, to do a larger apartment complex transaction. And oftentimes, they're setting up what they call a Regulation D 506 offering, right, a securities exemption. It's an LLC, if you will. And an IRA can be a member of an LLC. That's acceptable. As a passive investor, an IRA can be a member of an LLC. So another great way to be able to grow wealth in your IRA in a more passive way. And also think, for those of you who are raising money, who are going to move on to not just individual mortgages and trustees, but maybe a larger syndication, you can raise money from IRA investors through your efforts. Non-performing notes. Do we have anyone investing in distressed mortgages, non-performing assets? You can do that with your IRA. Making loans with your IRA, originating loans. Again, I make loans with my IRA. I don't buy mortgages or distressed assets. I simply work with a real estate rehabber in Tampa, Florida. When he finds a deal, he contacts me. I loan money, deploy the money with my 401k, traditional and Roth, and then I receive interest and principal payments on a balloon note. And those payments go back to my 401k tax exempt. Tax liens and tax deeds, not typically a strategy used by Ohioans, but we might have some people. Does anyone invest in tax liens by any chance? Does anyone head over to Indiana or Illinois and buy tax liens? Okay, no one. Some people buy them through a tax lien servicing agency, some go out and do it on their own. Real estate options and wholesaling. Great strategy for those that have a small amount of money in their IRA. Subject to deals, another great way with a small IRA to be able to grow it organically. Commercial real estate, vacation rentals. One thing you need to know about vacation rentals, you buy a vacation rental, can you stay there even one day?
No.
No, you can't do it. You cannot use your IRA assets for your own personal use. Okay, you need to know that. We'll talk more about that. Land, pre-developed, developing land, etc. Mobile homes. Does anyone invest in mobile homes? It's an interesting strategy. Marsha invested in mobile homes. I have a client in Cleveland, Ohio, bought a mobile home for $4,500. $4,500. Put $500 worth of work into it. It was practically tenant ready. He was in it for $5,000. He advertised on Craigslist, sold it for $10,500 to the tenant buyer. Tenant buyer needed financing. He got $1,000 down from the tenant buyer, carried back a note in the amount of $9,500, face value, principal value, and the interest and principal payments on a 12-year, fully amortized 5-year note was around $213. So $213 in the Roth IRA, tax-free every month. And then he went on and did another deal and another deal. And then he got his son involved. And his son was able to use the income through these mobile home purchases for his college tuition. So another great way to invest. Some people even take it a step further and invest in mobile home parks. Stan Brady, who I mentioned before, he actually invested using 10 IRAs, making a loan to a mobile home park operator on an equity participation basis. He had his IRA, his wife's IRA, his daughter's covered education savings account, his daughter's Roth IRAs, his in-laws' accounts, had all 10 IRAs in aggregate make a loan to this mobile home park operator, and all interest and principal payments flowed back into each one of the respective IRAs in accordance with the ownership interest in proportion to the initial cash outlay. So, again, I know I'm going a little bit fast here, but this is just kind of give you, from a macro perspective, all of the different things that you can consider, all of the different things that you've done before, are looking to do, have in process right now, you can practically do with your IRA plan. Investing in LLCs, I mentioned that. Oil and gas, precious metals, factoring, forex, equipment leasing, and show horses. So the tax code does not tell us what we can invest in, it tells us what we can't invest in. You can't invest in collectibles, you can't invest in life insurance policies, and you cannot, or your IRA or 401k cannot be a member of an S corporation. Those are the only things that you cannot do. However, your IRA can loan money to an S corporation. Know that. That's important for real estate investors. So the IRS, always think of it this way, the IRS is exclusive rather than being inclusive. And it states in black and white on the IRS website, you go to irs.gov, search in the search box, real estate FAQ, and it states in black and white that real estate is a permissible investment. However, due to the administrative burden, financial institutions are not required to allow you to participate in those types of assets. So it's not a matter of legality, but rather a matter of choice. That's why, going back to Marcia's point, when she went to her financial advisor, he said you couldn't do it, or she said they couldn't do it, right? Because that's not what they're good at. That's not their core competency. I mentioned some of those firms, Fidelity, Schwab, Wells Fargo, Pershing, specifically because we have developed relationships with all these institutions, and when they have clients that want to do self-directed IRA deals or have self-directed assets, they refer them to equity trust companies so they can transfer their funds and do their deals. So, again, it's not a matter of legality, but rather a matter of choice. So let's talk about these IRA plans so you can understand the fundamentals. Back in 1974, the Employee Retirement Income Securities Act was passed. Out of this act gave birth to all of these IRAs and 401ks, essentially, and they were phased in over many years. The traditional IRA was the very beginning, back in 1974. It's a tax-deferred IRA. So what does that mean? What that means is when we put money into the traditional IRA, whether we did it originally through a 401k, 403b, TSP plan, or we made a direct contribution to a traditional IRA, we get a deduction, right? So we get a tax deduction for the money going in. We grow it tax-deferred, and then eventually when we take the money out, after the qualified retirement age of 59 and a half, we have to pay taxes, all right? The analogy we use in this industry is you either pay taxes on the seed or you pay taxes on the crop. So with a traditional IRA, you didn't pay taxes on the seed, so eventually you have to pay taxes on the crop. Okay? Now, funding a traditional IRA plan. You might have a 401k, 403b, thrift savings plan, 457, etc. Once you've left that employer, you simply, or retired, you've met the qualifying event, you simply roll it over into an IRA. When you move over that 401k into an IRA, traditional IRA, self-directed of course, like we talked about, is that a taxable event? Are there penalties? No, absolutely not. You're just moving dollar per dollar over into the IRA, and then you can start taking that money out to do your real estate deals. Taking money out of the traditional IRA, sending it to a title company to buy a property, is that a taxable event or a penalty? No. Nope. Think of it this way. When I buy a stock, I'm going to buy Microsoft. I go through my broker and I buy shares of Microsoft. Cash leaves my account, my IRA account, buys the Microsoft stock. In exchange for that stock are stock certificates, right? We don't get physical certificates anymore. Everything is done electronically. But essentially, you get a stock certificate. When you buy real estate, think of it as the same concept. When you take money out of that IRA and send it to the title company, in exchange for that cash is a deed to a property. Or when you make a loan, it's a note and mortgage or deed of trust. Or you buy a tax lien, it's a tax lien certificate. You buy metals, you get the physical metal. Same concept, okay? No taxable situation, no penalties. That's very, very important because there's a huge misunderstanding in this industry and there's a lot of naysayers out there that make the claim that taking the money out to do a real estate deal is a taxable situation or a penalty. Now, when I have rents that go back in for my rental properties, that very much looks like dividend payments, right? When I make a loan and I have interest payments coming back in, that looks very similar to had I bought a corporate bond, right? And I have payments going back into my IRA plan. Okay, so think of that when you're trying to develop a concept. Yes, ma'am?
Is this all because the IRA is a corporation and the corporation of your business is a corporation, so there's actually no physical person that's doing, like you, because there's no, each one of them is their own person, right?
The IRA is a trust. Pursuant to the tax code, it is a trust.
Okay.
And you are considered the grantor beneficiary of that trust.
Okay.
Right? Equity trust, as your custodian, is considered the non-fiduciary trustee. You make all decisions on behalf of your IRA plan. Equity trust doesn't make any of those decisions. To answer your question, why is this possible? It's possible because under federal law, the IRA is a tax-exempt trust. And so when your IRA does any deal, buys a stock, buys a property, whatever it is, the income produced, and there's a few instances where your IRA can be taxed, such as when you take on debt, I alluded to that. But in 98% of the cases, all of the income goes to your IRA and it's exempt from taxes. It's just like if you're to buy stocks or mutual funds.
But what if I were doing a property and I was not an LLC? I was just doing it all by myself and I didn't have the protection of the LLC, but I did have the trust.
So
Would there be then a tax personally to me?
if your IRA, and that's a little bit more advanced, but that's okay, your IRA can buy a property, take direct title to the property, pay for fix-up and repairs, IRA receives all profits. In fact, if you go to public record and search equity trust, you're going to see equity trust company custodian, FBO, somebody's name or account number, IRA. Equity trust company custodian, FBO, somebody's name or account number, IRA. Those are clients of equity trust company. So you can take title to a property in the name of the IRA. Now, if your IRA became the 100% member of an LLC, and then the LLC went out and bought the property, the income is flow through. So the income flows through to the IRA, and you still preserve that tax-exempt status. Now, I will mention that when your IRA invests in an LLC, there are very, very specific requirements narrowing the scope of the operating agreement. You have to work with an attorney like John Heyer, somebody who is in Ohio here, he's in Columbus, that sets up these operating agreements, and they're not cheap, usually. So what I'll tell you is over 90% of people do not invest using their IRA through an LLC. And I know that it sort of contradicts traditional real estate wisdom, because most people say, I have to have my LLC do this deal, right? Or my LLC do this deal that I own personally. But your IRA, look at it as a completely standalone entity. Look at it having as a separate income statement and balance sheet. Your IRA will never invest into your LLC that you have personally. Your IRA will always do its deals itself as a standalone entity. If you do feel the need to have an LLC for additional asset protection, then your IRA would set up its own LLC. And your IRA would become the 100% member of that LLC. And then you would have a non-disqualified person serve as the manager, so you aren't violating the tax code. So, again, a little bit more advanced, okay, we can talk more about that. But know that in over 90% of the cases, clients simply take their IRA, set it up with equity trust, self-directed, move cash out, the IRA takes title to the property, the IRA rehabs it, or the IRA rehabs it, rents it out, or rehabs it and sells it. That's kind of the concept. So back to the traditional IRA. Funding the account, we can roll over from a 401k. You simply call the 401k company, initiate a rollover. If you have an IRA, you may transfer that into the self-directed IRA. You might not transfer 100% of the funds, maybe you just do a partial transfer. Some clients, they just transfer over what they need for an earnest money deposit, and then they transfer more money over at a later date. It's okay. Last but not least, you can make a contribution to an IRA up to $5,500 when you're under 50, $6,500 when 50 and over. Okay, cannot exceed that amount. That's irrespective of earnings, rollovers, and transfers. That's a common question. John, I am doing wholesale deals and I'm making $20,000. Have I exceeded the contribution limits? Nope. That's just what you take out of pocket and put into the plan. That's not earnings. The government's not going to limit you on earnings. All right? So traditional IRA recap, we don't pay taxes on the seed, so eventually when we take money out after 59.5, we then have to pay taxes. So if I have $1 million in a traditional IRA and I take $100,000 out at 60, $100,000 is added to my ordinary income and then I pay the taxes accordingly. Now some people want to transition away from a traditional IRA, maybe not 100%, but a portion, and do deals 100% tax-free. So the Roth IRA is a tax-free IRA. Using my analogy, with the Roth IRA, I pay taxes on the money going in, I pay taxes on the seed, then I don't have to pay taxes on the crop many, many years ahead of me. I personally, and not everybody's philosophy is going to be this way, but I personally no longer put a single dime in my tax-deferred accounts. I don't care about the deductions. I put 100% of the money that I can into my Roth account. If you couldn't tell, I'm well under the age of 59.5. I've been doing this for a number of years, been in real estate for over 13, but I'm well under 59.5. That is a joke, everybody can laugh, by the way. And so I see the value in me growing my Roth account, accelerating the income of that account so that I never have to pay taxes again. And guess what? I have about a 3.5-hour drive home this evening. I get in a wreck. This sounds really bad. Or I fly out of Cleveland quite frequently as well, about once a week. I go down in flames, or I get waffled by a bus, whatever. My Roth goes to my beneficiary, she gets it 100% tax-free. She doesn't have to pay a single dime on that money. So I'm preserving wealth for my loved ones. That's very, very important. It's important to understand this for estate planning purposes as well. Okay, so back to the Roth. I have a picture here of William Roth. He's the legislative sponsor for the Roth IRA, since deceased, from Delaware. We idolize him around the office up in our Westlake office. We have pictures of him around the office. My employees think I'm absolutely bizarre. The board thinks I'm absolutely bizarre that I do this, but I do believe and I'm passionate that if it wasn't for William Roth, I wouldn't be here today, and Equity Trust wouldn't be as successful as we are. Because we work with real estate investors that are looking to mitigate their tax liability. The Roth is the most powerful vehicle that has been afforded to us by the federal government. Because we can put money in, get the taxes out of the way, grow it 100% tax-free, and never pay another dime in taxes. And our children or grandchildren never have to pay another dime in taxes. We can use it for our higher educational expenses. So many ways in which we can capture that tax-free concept with the Roth IRA. Now, it didn't come about until 1998, so it shouldn't come as a big surprise that Roth IRAs are not as healthily funded as traditional IRAs, but that's okay. We're seeing more contributions being made to Roth IRAs now than we ever have before. Contribution limits for a Roth IRA, same as traditional IRA. $5,500 when under 50, $6,500 when 50 and over. I put $100 in a Roth IRA, or we do a minimum contribution, by the way, of $500. We put $500 into a Roth IRA, we do a wholesale deal, and we make $10,000 like Robert on an assignment fee. Have I exceeded my contribution limits? No. That's just what I put into the plan. Now, some people may have been told that they don't qualify to contribute directly to a Roth IRA because they make too much money. Who has heard of this before? Make too much money, can't put money into a Roth IRA. Starting in 2010, that's no longer the truth, because the law was passed that lifted the MAGI limits indefinitely, and this is a little bit more advanced. But what I want everybody to know here is if you're told that you make too much money and cannot contribute directly to a Roth IRA, and the MAGI limits are here, if you're single and you make between 116 and 131, you only qualify for a partial contribution to a Roth. You make over 131, can't contribute a single dime to a Roth. If you're married filing jointly, you're between 183 and 193, you can only do a partial contribution to a Roth IRA. You make over 193, can't contribute. All right? Know that if you make too much money or are told that you make too much money, you simply use what they call a backdoor Roth approach. You put money into a traditional IRA first, which there's no income limits, and then you immediately convert over to a Roth IRA. And you can do that through a SEP, or you can do that through a traditional IRA. All right? So what I want everybody to know, and write down if you need to, you make too much money, or you anticipate eventually making too much money, you can still contribute to your Roth IRA, you just have to go about it a little bit different way. Put it into the traditional, convert over to a Roth. Okay, speeding up a little bit, this is what we call a Roth conversion. So I have money in a 401k, traditional IRA, tax-deferred account. I say to myself, going back to my analogy, I want to pay taxes on this seed so I don't have to pay taxes on the large crop later on in my life. So I can simply take money in my 401k or traditional IRA and convert it over to the Roth and pay the taxes. It's called a conversion. So using this example, I take $100,000 and I put it into my Roth IRA as a conversion. I get the taxes out of the way now. That $100,000 is added to my ordinary income. So I have to be aware of that. It's going to increase my effective tax rate, right? We're going to assume an effective tax rate of 20%. That equates to $20,000 of the $100,000. So I pay $20,000 to the service, right, to get this $100,000 tax-free, and I never have to pay taxes again. Now, if I did a long-term analysis, I might say to myself, hey, over 20 years of retirement, I'm taking distributions from my traditional IRA, I'm going to end up paying $200,000. I'd rather pay $20,000 in taxes now, get it out of the way, so I don't have to pay $200,000 later on in my retirement. A lot of real estate investors get to that point.
And if that investor is over 59 and a half, that 20,000 can be reduced down to 10%, correct?
Not necessarily. The 20% is the actual tax. What you're referring to is the penalty. That's a good question. I'm under 59 and a half, as we talked about, very obvious. If I do this transaction, I don't want to take money from the account to pay for the $20,000 in taxes. I'm going to take that out of pocket. Why is that? There's two reasons. One is because of my age. I'm under 59 and a half, so I'm subject to what? 10% penalty on my withdrawal. What's the other reason? Going back to the concept of the doctrine of the fruits of the poisonous seed, the concept of tax-free dollars. I don't want to cannibalize my IRA, right? I cherish those tax-free dollars. So I want to keep as many of those tax-free dollars in that account as I can. All right? Now, I may say to myself, I don't want to convert the entire amount. So I am going to convert, let's say, as a for instance, I think Scott and I were talking about this earlier, I'm going to convert half of the $100,000, $50,000, so I can reduce my tax liability by 50%, which is $10,000. I might convert as I look at a transaction. So I got a great wholesale deal. I got $50,000 in a traditional IRA. I only need $500 as consideration. Would I rather pay taxes on the $500 or the $10,000 in my assignment fee that I receive? Right? So I might consider converting as I have deals present themselves. You can actually convert assets in kind. So I know we have some clients here. If you have properties, notes, etc., you can actually convert those assets in kind, okay, at their fair market value. But again, we're not going to go too far in the weeds there because we'll be here until 10 o'clock. Here's a case study of a client who did a conversion of a property and then made a significant amount of money, all of which is tax-free. This is John Pacilio from Carmel, Indiana. Indianapolis area is where he's from. He is a realtor, active real estate investor. He co-invested his wife's traditional IRA and his traditional IRA. They had 401ks from previous employers. They rolled them over into traditional IRAs. And then they bought this property in a suburb of Carmel, Indiana. The purchase price was $74,000. I want to say it was a 4-bedroom, 3-bath home. So we got this distressed deal under contract in the name of the IRAs. As you can see, they're Equity Trust Company, Custodian, FBO, John P.'s IRA, undivided interest, 82%. And then his wife's IRA, undivided interest, 18%. That's the titling that must be used. If you know you're going to open an account with Equity Trust and put deals under contract, you need to make sure you use the proper IRA titling. Now, when I do deals, I don't put my name in where you would put your name. I use my account number. Why do I use my account number? Anonymity. So instead of being Equity Trust Company, Custodian, FBO, my name IRA, I simply put Equity Trust Company, Custodian, FBO, my account number IRA. That way my name doesn't show up on public record.
We can do that on real estate deals too?
Real estate deals, loans, whatever deal you're doing, you never have to put your name on title. Use your account number. Every client that comes to any of my classes never uses their name ever again. No reason to do it. You don't have to, don't do it. Keep it off the public record. So on this deal, his wife unfortunately did not have enough money in her account to put together the whole deal. Okay, so he put it together 82-18. Now it was in 2009, he bought the property. He had the expectations that the state of Indiana was going to need that property and was going to tear down the property because they needed the land for a major road project that was going in. I want to say it was an on-ramp for a freeway. So it's practically a given that they're going to make a significant offer. So bought it for $74,000 between the two traditional IRAs, and subsequently after buying it, they converted the traditional IRAs, so they paid taxes on $74,000. Okay? Now they had it in their Roth IRAs. They sold it about 3 years later for $210,000 to the state of Indiana. Meanwhile, they're renting it out at about $1,650 per month. So they bought it for $74,000, $13,320 from the wife's IRA, $66.80 from John's IRA. Subsequently converted, paying taxes on the $74,000. Sold it for $210,000, $38,000, which proportionally of 18% is $24,680 on the gains to the wife's IRA. Tax-free because it's a Roth, right? And then $172,000, $112,800 on the gain for John's Roth IRA. That's over $137,000 tax-free. So would you rather pay taxes on $74,000 or $137,000, right? That's the concept here. Meanwhile, they're renting it out, as you can see there, $49,500 in the net operating income to the IRA plans, 18%, all of which went to the wife's, $45,990, which went to John's IRA plan. Okay? So when their tenants made checks payable, they didn't make them payable one to one IRA, one to the other IRA. Simply made payable to Equity Trust for the benefit of IRA 1, IRA 2. They mailed in, we deposited 18% into the wife's, 82% into John's. Okay?
And you receive those rents and track those rents.
Correct. Now, you will likely get the check from the tenant so you know you got it and then mail it to Equity Trust Company. But ultimately, the checks are not payable to you or your business or anyone else for that matter. They're made payable to your IRA and deposited with Equity Trust Company. You mail it to our offices up in Westlake, Ohio. We process that immediately. We'll talk about the online bank account that you use to monitor all of this activity.